Hey, welcome to the show. Total Financial Solutions, Safer Money Hour. Arif Halaby, Total Financial Solutions, along with Jeff Girard. We're talking about your family's finances, of course, getting out of debt, managing your retirement, planning for your future. It all centers around a few things. Number one, taking care of ourselves. Very big deal, very big part of why you're saving. That's what we all do. It's what a big part of our life is about. But in addition to all of that, it's setting down, generally speaking, for your family. Setting down a future, setting down some safeguards, maybe taking care of a special needs child or a special needs spouse, sibling, parents. How do you do all of that? How do you build all of that and yet still know you're doing the right thing and yet planning? So there's a lot of mistakes people make when it comes to the beneficiaries, when it comes to the mistakes that they might make with laying out their retirement accounts, life insurance, same ideas, anything that has a beneficiary associated with it. Now, Jeff, a few years ago, when you had a savings account at a bank, it did not have what's called a TOD, or transfer on death provision. It was just, hey, you pass away, it was a savings account, it went into probate, and there was really no other way to do it except through probate or joint signatures, things like that would often be problematic.
Sure.
But today, they have this TOD, or transfer on death. Basically, it circumvents probate, it seems.
That's right, because a lot of times we take for granted that our assets, whether it's a savings account, a house, a car, a retirement account, a life insurance policy, we know who we want those monies to go to. We know who we want those monies to benefit if we pass away. But the way the accounts are set up, there are legal ramifications to how things are structured. And so when you don't have those provisions, those transfer on death provisions, if you don't have those things built into the accounts, like Arif was saying years ago, people just kind of went without those. And unless it was an IRA or a retirement account at work where, believe it or not, some people still didn't have beneficiaries named on those types of accounts. But unless it was one of those, that part wasn't built in. So you had to have a special thing. But gosh, who thinks about that? You go into a financial institution, a bank, a credit union, and you say, I want to open up a checking savings account. What's the first thing you ask for? What are the fees?
Yes.
And are you going to pay me any interest? You're not talking about beneficiaries.
No, because most of the time beneficiaries, you want to die spending your last penny. You know,
That's right.
Who is it that said they want the check to bounce, the last check they write to bounce or something, just as you pass away. And the idea is you've saved and worked hard for you. Well, very few of us know the date we're going to pass away. You know, I would venture to say it's not a common thing. So you're planning for just in cases. Now, there's a big fear that goes through this, which is often as we're saving and planning for retirement, you don't know when that last day is. So am I supposed to keep a lot of money saved? Most people spend, I think it's half of their money that they've saved in their lifetime, the last 5 years of their life. I mean, can you believe that? You're saving all of your money so that a nurse that you may not even recognize, a doctor who you certainly may not really like, they actually get all your money. Not your children, not the charities, the church, the organizations. In some cases, not even your spouse, because you're going to need to live. So how do you plan so that you're building this properly? So we want to go over some of the beneficiary mistakes that people make. And this is by personal experience. You guys have heard me, for some of you who've listened for, I guess, coming up on 12 years. In a couple of weeks, it will be 12 years in the air here at KHTS. Kind of weird that it's been that long. And so I know we've covered this a little bit over the years. However, here's an important part to this. You need to hear it again. We had a client early on. She calls up and says, hey, Arif, I got this check in the mail from an insurance company. It's $250,000. I was going to throw it away. I was going to shred it. I'm not sure if it's real or not. Can you tell me what it is? I said, well, it doesn't sound like... I said, what company is it from? She tells me. I said, it's not a company that you currently have with us, so I don't know where it would be from. But I'll tell you what, I'm going to be in the area this week. I'll come by, swing by, I'll take a look at it. So I go by, I look at it. It looks legitimate. It looks pretty real. I take a look at it. I said, you know what, let me make a phone call tomorrow. I'll see what I can find out, and that will tell me, what's going on. So next day, make a phone call, and here's what ended up happening. This particular client was married years ago when she was 18, 19 years old, and only for a couple of years. But at that time, her young husband, who was about a year or two older than her, maybe 20 at the time, got a job with the city of Los Angeles. So he was a city employee. signed up for the free life insurance that you get, very discounted, freely $10,000, $5,000 life insurance. They go on their way. They stay married for about 3 years, and then they divorce. No children. They separate. A couple of years later, they remarry. They go on their way. They have their own families. They never see each other again. 25 years plus pass, and she receives this check in the mail. Well, apparently, when they were first married and he got the job with the city, who do you put down as a beneficiary?
Your spouse.
Usually.
Yeah.
Yeah, usually it's your... Now, if you're not married, it might be your mom or dad, it might be your sister or brother, but it's usually somebody like that. It's usually somebody that at that moment in time you want to, if God forbid something happens to you, you want to have. Well, here's what happened. He kept increasing his life insurance. He kept putting, I've got a promotion. He was a supervisor when he passed away. And at that point in time when he passed away, as a supervisor, he had $250,000 in life insurance. Well, meanwhile, he had remarried, had a whole set of children, another family, a whole life outside of this lady. Didn't know anything about this lady, of course, anymore. Well, guess who gets the money?
His ex-wife.
She does. She gets a $250,000 check, tax-free. Cash money, folks.
Wow.
Now, she had two options. One of her options was to recuse, to say, I don't need the money, I don't want it, it's not mine. And then it would go back into his estate and most likely would have probably gone to his wife. Okay. Or she could cash it. There's no legal issues. There's nothing. It's a beneficiary. The beneficiary forms are contracts. This is how ironclad, if you will, that they are. It locks down those dollars specifically for the beneficiary. And of course, what do you think she chose to do with it?
Shopping.
Yes, she did go shopping. She kept the money. She didn't give it to her ex-husband's wife and whatever children or grandchildren they may have had, and they kept the cash. So you need to know, if you're married to somebody who had a job or a life insurance policy prior to knowing you, you need to make sure that that policy has you as the beneficiary. It doesn't matter if you're using joint funds to pay for it. It doesn't matter if it's coming out of your joint checking account. It doesn't matter any of that stuff. What matters is whether or not the beneficiary is done at the time the life insurance is taken out, whomever that person is. All right. So those are some of the blunders. Forgetting to do a beneficiary checkup on those dollars.
Yes.
If it's meant to be your current spouse, your former spouse. Now, sometimes legally you're locked into these. In other words, if you separate or divorce and you owe child support or life insurance, child support or alimony, the life insurance is used as a way to back up or protect that paycheck that's going to the kids or your ex-wife or ex-husband. So think about that. Sometimes life insurance, you can't make the beneficiary changes because you're court ordered. So there are some nuances to that rule. But
well, and I think that's a great point, because sometimes we have to look at life triggers, if you will. A divorce, getting married. Arif, you brought up a great point. Let's say I'm a young man, and before I'm even married, I open a life insurance policy, or I get the free one at work, and I name my parents because I'm not married. All these years go by, and let's say, I don't know, it could be parents, it could be grandparents in this case, and they pass away, and they were your primary beneficiaries. You didn't update that. You think it automatically goes to your spouse. You're married. You carry on about your business, your life. You pass away, and you don't have a primary beneficiary because they were older than you are, and they predeceased you. So now that could put a little bit of a twist on that. Maybe the money goes back into probate. Maybe it makes it difficult for your spouse or your family to get the money if it's your kids. So the updating part of the beneficiaries is very important, because it just takes away a lot of the red tape. These contracts, whether it's a life insurance policy or some type of stipulation on an account that was supposed to go to your beneficiaries, these are basically, like Arif said, ironclad. So to deviate from that, you'd be really hard-pressed to try to get a different result. So just the easiest thing and the best and simplest thing to do is to just check these and update them often. Yeah,
it can easily be done with one form. It's simple to do. I'm going to give you an option here that a lot of people use, especially if the beneficiaries that you use or would like to take care of can vary, meaning right now you're taking care of your sister and her son, but eventually they're going to be on their own. And so, there might be some nuances to your particular plan, and those variations will maybe need to be changed multiple times a year. So how do you do that? Instead of going to each one of these beneficiary forms, and how do you make sure that you're doing it? Often people utilize, it's been my experience, they will use a revocable living trust. So using a revocable living trust as the beneficiary, and so consider it like a funnel. All of your assets, all of your accounts will funnel into that revocable living trust. So your beneficiary would be the trust. Now, we have found a lot of clients will choose to have their spouse be the primary beneficiary. And then if something happens to both of those, then it goes down to the trust.
Right.
Part of the challenge is you've got to look and say, what do I want who to have when? Right? Let me give you a good example. If your kids are 18, 19 years old and you pass away and they receive $1 million life insurance policy, how quickly do you think they're going to crash into the wall, burn, and maybe even die themselves?
Yeah.
Probably pretty quickly. You're going to see multiple times people will put provisions in there that say, how do I give the money to my kids? How do I give the money to my minor children? But slowly, over time. Well, all of that can be in the revocable living trust, meaning all you have to do is change one document. As your kids get older, they were minors before, now they're college graduates. They were, in their teens when you first did your revocable living trust and did your insurance and your retirement accounts and your 401ks and all that. And today, they're 25 years old, they're married, they're 30 years old, they have a career. So you might do different layers based on their ages. Well, all of that can be done with one form, if you will, through the revocable living trust. Your attorney now, look, Jeff, we have seen financial guys, try to set these things up.
Sure.
And they might be great, they might be good, they might be amazing. But we've also seen plumbers try to do electrical work.
We sure have.
I've seen CPAs trying to be financial advisors. I've seen financial advisors trying to be living trust attorneys. It just doesn't work. Maybe I'm wrong, but it's my opinion that a screwdriver does a screwdriver's job, a hammer does a hammer's job, that in many cases, having the right professional and spending a few dollars today will save you and your family a lot of money later.
Well, that makes a big difference, because if you take a look at a revocable living trust, or a trust for that matter, any trust really, has a lot of what? It's got a lot of written language in there, a lot of copy, a lot of text, and someone gets paid. Someone's gone to school for almost a decade in some cases to interpret that sort of thing and to write the proper language in there. So taking something that maybe somebody else created, and I'm not saying that this is bad, like Arif saying and we're not saying these are bad things, but if you want something customized, you generally have to pay a little bit more money than something that was maybe templated that you could find just about anywhere. And what I mean by that is, if it was written already for somebody else, why does that apply to you? So you have to kind of think of it that way. So when you have a living trust, there is language in there. And remember, these are the rules that somebody that administers this will follow at your death. You don't get to go, oh, hey, hang on, let's go back to, paragraph 3, clause 2, 1A, and this is what we really meant. No, it's somebody else that doesn't know you, potentially, that gets to interpret this. And what does that really all boil down to? It means that whoever was interpreting that will say where the money goes. So a lot of it's streamlined, a lot of it's pretty simple and straightforward, but in our experience, have somebody that does living trusts for a living. One of the things that they do very, very well would be a living trust. This is a living, breathing document, and it does have an immense amount of control over your estate at the time that you pass away. So kind of put some thought and some respect into that part of it, and I think you won't be steered wrong. Yeah,
think of it like as Jeff's saying, a living, breathing document, meaning you can make adjustments all the time. You can add provisions. You can disinherit that brother-in-law, or that you can take that wayward child and lock them out of the trust. You can give them $1 so that when they sue, that's all they get if they sue the trust or whatever. You can do all those little crazy things.
Right, because your life insurance policy just says here, I have 3 kids, pay these 3 kids out.
Done.
That doesn't say this one's good with money, this one doesn't need it, and this one's terrible with money. You know, be careful with this one when you write the check. They don't say that. That's why you need that living trust.
When we come back, we're going to talk about some of the blunders people make when they name their estate as the beneficiary. Did you know that could be one of the biggest mistakes you make, both financially and probably based on your wishes down that road as well when we come back? Total Financial Solutions, Safer Money Hour. I'm Arif Halaby, along with Jeff Girard. Welcome to our 12th anniversary show. That's this month, right here on your place for news, talk, and information. AM 1220 KHTS.